Hey traders, this is Blake Morrow with Traders Summit, and with me once again is Brent Johnson, CEO of Santiago Capital. Good to see you, Brent.
Thanks for having me. Happy to be here.
It's really great to have you here. Now, you are the CEO of Santiago Capital. You manage portfolios, but you're not so much a trader, right?
Yeah, that's right. So I've been in the wealth management business, for lack of a better word, for a little over 20 years. I've got several high net worth clients where I do customized portfolios for them. And for the most part, we are long-term investors, and we have long-term asset allocations that we tweak here and there. Yeah. So I'm not like a day trader. I'm not always out there trading. When things get more volatile, I will do more trading. And we have a part of the portfolio that's a hedge against everything else. And in that hedging strategy, we do more trades. But I'm constantly looking at stuff and analyzing stuff, even if I'm not doing a trade on it, because I think whether you're doing the trade or not, it still influences the overall portfolio.
I was going to say, so many people turn to you, myself included, for your views on the dollar, and you really focus a lot on what's happening in the currency market, what's happening in bonds. Why is that? Is your focus so much on the currency market?
Well, I think the currency market, the currency market's the biggest market in the world. And yet I think it's probably, for most people, at least retail investors, it's the last thing they think about, right? Yeah. And I think they need to think about it more. And part of the reason that at least people in the US don't think about currencies is because we have the global reserve currency and the whole world operates in dollars. So we don't really have to think about currency exchange rates. But if you live in Brazil or Argentina or China or Russia or Turkey, you have to think about relative currency levels all the time. And I think the fact that we don't have to pay that much attention to it in the US is an underappreciated reality going forward. I think you do need to pay attention to it.
And isn't it true? I mean, being the largest market in the world, there's so many underlying shifts underneath the surface that it really impacts everything that we do, from equity markets to the bond market, to currencies, to cryptos even.
Absolutely.
All right.
Absolutely. Well, the one thing I'll just jump, I'm not sure, I'm guessing that a lot of your listeners are from North America, but to the extent there's, listeners from Asia or Europe or Africa or wherever it is, I think we're in a really interesting time right now, because where we're at is that we've obviously seen inflationary pressures over the last couple of years in all currencies. But, we're at this place where I think countries around the world are going to be experiencing inflationary pressures in their local currencies, but deflationary pressures in the funding currency, which is the dollar. And that's kind of a unique phenomenon, which I think the whole world's going to have to wrestle with over the next couple of years.
It's interesting that you point that out. So you kind of are leading me down the road of talking about something I didn't want to hit initially, but let's talk a little bit about Japan. And I'm going to pull up a longer term chart of the yen here, just so everybody can have a view of what we're really talking about. But the yen has seen a massive move lower. And we've seen the dollar yen rally to levels that we hadn't seen in 20 some odd years. How is this kind of what you're talking about, where the currency is absolutely getting smashed? But what's Japan going to do about it? Because they import so much, and what do they do with this weekend?
This is a perfect example. And if you take this chart back 40 years, I don't consider myself I'm kind of an armchair technical analyst, but I love looking at charts because there's a lot of information embedded in a chart. But yeah, here's like the 20-year chart. And if you took about it back another 20 years, that same line would extend. And so what the yen has just done, this is the yen futures, it's just broken through a 40-year support line. And I think it's maybe the most important thing that the overall market's missing right now. And whichever direction it goes from here, I think it has the potential to cause chaos. And let me tell you why this is. Okay, so the fact that it broke through this 40-year support line means that it's extremely weak. The reason it's extremely weak is the Bank of Japan has to make a choice. Do they save the bond market and keep yields low, or do they save the currency and let it devalue? And so far, they have said, we are going to buy as many bonds as we have to in order to keep rates low in Japan. And so as a result, the currency is suffering. Now, as a result of it going down a lot, the whole world is short yen. It's used as a carry trade. People borrow it and then go invest elsewhere because interest rates are so low. And then as it's fallen down, just speculators of it going lower have piled in. So short yen is an extremely crowded trade right now. And perhaps it continues to go down. But if it does continue to go down, what it does is it puts pressure from a regional perspective on China, because now Japanese goods are more competitive with Chinese goods. And China is wrestling with deflation in their real estate market and inflation in their energy imports and their food imports. And so, China may have, and the last couple times back in, I think, 2013 or 15, and then back in 2018 or 19, the last couple times the yen weakened significantly, it eventually led to minor devals or soft weakening in the yuan. And when you look at it on the chart, it doesn't look that spectacular. However, you have to remember that the Chinese yuan is a managed currency. It's a pegged currency. So the fact that it moved at all and that it weakened at all meant that the PBOC was feeling the pressure and had to let it go a little bit.
And that's what you're seeing right now.
And that's what you're seeing right now. So I'm glad you brought that. This is a great chart right here. I mean, for the last, call it year and a half or year, money has been flowing into China for two reasons. One, there was growth coming from China, and two, the yields on their 10-year treasury were much higher than the US 10-year treasury. However, with the rates rising now in the US to the level they have, the premium that you got for buying Chinese 10-year is gone. In fact, I think you might even get paid more now to be in a US bond than a Chinese bond. So the point is, why would you hold a Chinese bond, which the market's much less open. There's many more restrictions on it than owning the 10-year US Treasury, which is the most liquid thing in the world. And so you've started to see outflows from Japan or from China. And as a result, they're having to weaken the currency because the flows aren't there to support it anymore. So, and here's the thing: is if China, I know I'm rambling a bit, but
no, that's fine. That's fine. We love it.
If China has to let their currency weaken, or if they devalue it on purpose, they would be doing that in order to fight deflationary pressures in their own economy. So what they're doing when they do that, they're pulling in inflation from outside the world into China, and they're pushing their deflation that's in China out to the rest of the world. And so this is why I think this is so important right now, is we're kind of on this razor's edge between inflationary pressures and deflationary pressures. And we may get the worst of all worlds, which is stagflation, when you have certain goods going up in price, but revenues or other goods going down in price. And you just get, your profits just get squeezed. And so that's what would happen if the yen continued to weaken and the yuan were if the yuan were to weaken. But let's take the other side. I said the short yen is a very crowded trade right now. It wouldn't take a whole. So I think the Bank of Japan is finally starting to feel some pressure. You've actually seen some comments out of some Japanese corporates over the last week says, hey, we get it that we need a weak yen, but we don't want it totally weak. There's some downsides to having a weak currency as well. And so, it wouldn't take a whole lot for the Bank of Japan to come out and say, you know what, we are going to support the bond market, but we also don't want the currency to totally crash either. If they just made a hint at that, you could get a short squeeze in the yen that would go back up and at a minimum kind of retest that support line that it broke. Yeah. Now, if that happened, that would probably be a major risk off move for markets. Typically, in a risk off move, you see the yen rallying. But because it's such a crowded trade, and because so many people short the yen and then use those proceeds to go buy somewhere else, if they now have to liquidate those positions to cover their yen short, you could cause a lot of volatility in debt markets, in currency markets, in equity markets, in commodity markets. So I guess this is my point. Regardless of which way the yen goes from here, I think the potential for volatility is very high. And that, even though why I'm not necessarily trading the yen, it's why I look at it and why I think it's so important.
Wow, that's it's great that you're putting this all together. But what is that going to mean for the dollar? I mean, when you look at the dollar index is really attacking this is again a weekly chart. We're looking at a couple of decades worth of data. And you can see here that the dollar is really challenging some pretty key resistance. And maybe, or I want to ask you this, is one of our saving graces at this point by having a stronger dollar, is it helping us as far as these inflationary pressures that we are feeling here in the United States? And I know you don't live in the United States at this moment, but you get what I'm saying.
Yeah, no, I think, this is the point of, because we live in the U.S. and the dollar is strong, while we are experiencing inflationary pressures, it's not as bad. Now imagine that you lived in Turkey, or imagine that you lived in Japan, or imagine that you lived in Egypt, where where the currency is not strong.
Sure.
And then you have these high oil prices, and you have these high food prices. This type of event is what's led to the Arab Spring about 10 years ago, all across the Mideast, was high energy prices and high food prices. When people are hungry and cold and can't work, and that's when that's when revolutions typically take place. And I don't want to be overly dramatic about it, but that's just a reality. And the dollar, what I would say about the dollar here, and this is kind of what I've been pounding the table on for a couple of years, is I understand all the negative aspects of the dollar. I totally agree that our government's out of control. Fiscal policy is horrible. We've borrowed more than we can ever repay. We just print the money. Oh, I totally get it. But the thing you have to remember is that everybody else is doing the exact same thing. And if you look back to 2008, right before the global financial crisis, the dollar was in the mid 70s. And now, 12 years later, after QE1, QE2, QE3, Operation Twist, the COVID bailouts, the helicopter money, the stimulus checks,
all the things that should have made the dollar crash, right?
Exactly. And yet it is still hitting this long-term resistance and threatening to break through it. Now, my guess is that it'll probably pull back a little bit here. That's typically what happens. It's been on a pretty good run. But I'm just convinced it's going to break through that resistance to the upside. Again, not because the dollar's a great currency, but because everything else is just horrible. And that is going to cause, again, this is just another place where the currency market will affect real estate markets, it'll affect debt markets, it'll affect equity markets. So I just don't think you can ignore it.
So Brent, as currency traders, and that's something that I love as personally as a trader. I've been focused in the currency markets for a couple of decades now, and that's really what I love to do. And I know as a currency trader, the markets tend to move on interest rate expectations and interest rate moves just in general. So I got to ask you, why do you think, and just your opinion here, I'm going to turn our attention just over to the euro. Why is the euro held up this well based on what's happening in Ukraine? Obviously the Russia invasion. You've got the ECB that seems seemingly just like blindly dovish, I guess I could say. But expectations for the Fed and what we're going to do in 2022 has ratcheted up higher exponentially. Can you explain why the euro is holding up as well as it is, or are you surprised?
So here's the interesting thing: is if you did this exact same chart on the euro that we just did on the yen and take it back 40 years, it's literally sitting on 40-year support.
Right. Right.
It is. And so, but to your point, it has held. So far, it has held it, and maybe it will continue to hold. I don't know. It's kind of right there, right? And so, it has held up relatively well. But I think part of it, and this is maybe just as my own bias, and I admit that I am biased on this. Everybody has their biases. Everybody tries to protect against them, but
sure, it
seems to me that Europe has always been characterized by the hope of a better future, and that they will figure it out. And all the, every time the ECB says something like, "Oh, we are now going to cooperate," or "We are now going to launch a joint bailout resolution," or whatever it is, like the market always believes whatever the ECB says, I feel like. And I feel like the ECB is even better at jawboning the market than the Fed is. And now maybe I'm wrong, but I think that's part of it. But I think we're getting to the point where they're not going to be able to jawbone it much more. And if this support goes, it's going to be a major event. And I think we're going to parity. And I think we're eventually going lower than that. But, something's coming up this weekend is the second round of the French elections. And it's down to Macron and Le Pen. And, if Le Pen were to win, and I don't know if she will or not, I think the odds against it are higher than her winning. But People said that about Trump in 2016 as well, and look what happened. If she were to win, I would imagine that would that would break that support. So there's a lot of stuff going on in the currency markets that are going to have profound effects for the overall markets. And I really think we're just getting warmed up. I still, I need to hold up my hand. I've been talking about this for 3 or 4 years. And the truth is I got on Wall Street, if you get the timing wrong, you're wrong. So I just need to say I'm wrong. I got it wrong. I thought this was going to start 2 or 3 years ago, and it didn't. But it doesn't mean I'm going to be wrong for the next 2 or 3 years. And I think this is really now just getting started. We've got, and I think when the euro breaks through this to the downside, when the dollar breaks through that other one to the upside, when China has to start weakening their currency, we're going to see a lot of fireworks across a number of different markets.
So I want to pick your brain about one more quick topic, and I want to talk a little bit about U.S. Treasuries. I mean, the bond market is obviously, after 30 some odd years of a rally, we're actually looking kind of gross here. How do you feel about the bond market at current levels? I mean, have yields peaked? There's a lot of people talking about it. A lot of banks are suggesting that that's what it's going to be. But do you really believe that?
It's really hard. This is a really hard one. To be honest, I'm a little bit agnostic on the dollar, or I mean on the Treasury. And here's why. Like, I'm a big dollar bull, and so a lot of times people think that I'm automatically a Treasury bull. I think the odds are higher than lower that we're going to get another rally in Treasuries. Whether we go a little bit higher in yields first or not, I'm not sure. But I do think when we get a risk-off event, Treasury yields will come down. Now, I think it's unlikely that we go back to 0 or negative rates. Some of my friends are convinced that's what's going to happen, and maybe that will. But the thing I would say with regard to Treasuries, and again, this is how I look at it, and it's kind of similar to how I'm looking at the yen right now. Regardless of which way it goes, I think it means volatility. And let me tell you what I mean by that. If yields continue to go higher, it just makes dollars more attractive because you get paid more to hold dollars, right? So yields going higher is actually supportive of dollar strength versus yuan, yen, euro, and a number of other currency pairs. But if that yield comes down, that's probably a signal that the rest of the world's not as healthy as you think it is, right? And that's probably a signal of risk off. So regardless of which way that goes from here, just like regardless of which way the yen goes, I think the rest of the year is going to be very volatile. I don't think we're going to go back to a market like we had in 2021, where volatility stayed between 18 and 22 for a year, and everything just went up and to the right. Yeah. I don't know which way asset prices are going to go, whether it's higher or lower, but I don't think it's going to be a smooth line regardless of which way they go. I think you're going to see great volatility in both directions.
Well, we're gonna end on that, and I have to say, Brent, one of the things I love doing is actually following you around on Twitter and getting tuned in to some of the conversations you have in social media. But as a trader, if they're at home and they want to follow you a little bit closer, how do they do that?
So I'm pretty active on Twitter. The handle, you can look up Santiago Capital. It's a seashell is the symbol. The handle is Santiago AU Fund. You can find it that way. If you just Google Santiago Capital or Brent Johnson, or do that on YouTube, you'll get a number of links, a number of interviews. And if anybody has specific questions, I don't mind if they email me. Unfortunately, I get a lot of direct messages and emails and stuff, and I try to answer them all. I'm not always successful, but I don't mind if you give it a shot.
What's funny is I actually have a cousin who's named Brent Johnson. But if you Google Brent Johnson, you're the first one that comes up, and that's pretty cool.
Well, it used to be somebody used to tell me whenever they would get this hockey player from St. Louis. So I don't know if that's still the case.
I think you might have jumped him.
I'm not a hockey player from St. Louis.
Well, Brent, I want to thank you for your time. I know it's very valuable. It's very valuable to us that you spend it with us. And guys and gals, if you like what you heard from Brent, make sure you follow him on Twitter. Make sure you give him a thumbs up and subscribe to the channel so you don't miss any of our great content. Brent, thank you so much for spending your time with us, and we'll talk to you very soon.
All right. Thanks for having me.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.